So before you trust a high-yield savings account, there's something you need to know, because the number you see isn't always the number you keep. Frugal Fox sits at his kitchen table, laptop open, coffee steaming. A flashy ad pops up on the screen. 5.25% APY, risk-free. 5%. Just for saving? That sounds like free money. But when a high-yield savings account pays you interest, that interest is taxable income. That means the bank pays you interest. The IRS treats that interest like earned money. You owe income tax on it. So the APY you see is not your net return. Hey, welcome back to the channel. I'm Frugal Fox. If you've ever wondered whether high-yield savings accounts are actually worth it, and what they don't tell you about the interest and changing APYs, you're in the right place. Before we jump in, hit like and subscribe, and let's make sure your money is working for you, not the bank. APY stands for annual percentage yield. It shows how much your money can grow in 1 year, including compounding, not just the interest rate. Banks set APYs themselves based on Federal Reserve rates, competition, and their need for deposits. APY can change anytime, so it's not a promise, it's a snapshot. APY shows how much your money can grow in a year, including compounding. Compounding means your money earns interest, and then that interest starts earning interest too. Over time, this creates a snowball effect where growth accelerates without you adding more money. The longer your money sits, the harder it works for you. A high-yield savings account sounds like the smartest place for your money. Higher interest, no market risk, and easy access whenever you need it. On the surface, it feels like a no-brainer. Even Frugal Fox pauses with his finger hovering over Open Account. But beneath the shiny APY, there's a detail most people miss, one that changes what you actually keep. Here's what most people completely miss. That interest you earn in a high-yield savings account isn't free money, it's taxable. That means if your account earns $1,000, you won't actually keep all of it. Depending on your tax bracket, a chunk goes straight to taxes, quietly reducing your effective return. The interest you earn in a high-yield savings account is taxable income. Even though it feels like your money is just growing, the IRS treats that interest like earnings. At tax time, the bank reports it, and you may owe federal and sometimes state taxes. So the APY you see isn't the amount you actually keep after taxes. For example, so if I earn $1,000 in interest, I don't actually keep $1,000. Depending on your tax bracket, you could lose 20%, 25%, sometimes more. Your high yield just got shorter. Let's say you earn $1,000 in interest from a high-yield savings account. You're in a 22% federal tax bracket. You don't keep $1,000. You keep about $780. The other $220 goes to taxes. So that 5% APY quietly turns into 3.9% after tax, before inflation. That's what not the number you keep means. Many savers don't account for the taxes on the interest they earn. At tax time, they're often surprised to see a smaller payout than expected. This can make your savings feel less powerful than it seemed, especially if you have a large emergency fund, high interest rates, or multiple accounts earning stacked interest. Taxes can shrink your savings, but that's not the only surprise. The APY a bank advertises isn't fixed. It can go up or down throughout the year. That means the growth you expected when you open the account might not last, so your guaranteed earnings can change before you even notice. Banks change APY to match the economy. When interest rates go up, they may raise your savings rate to attract money. When rates fall or they have enough deposits, they often lower it. That 5% APY you see today isn't permanent. It can change anytime based on the market and bank decisions. APY can change, but you can stay ahead. Shop around for better rates, consider online banks that often pay more, and spread your savings across accounts to take advantage of higher yields. Most importantly, focus on consistent saving and long-term growth instead of chasing every small rate change. High-yield savings accounts aren't bad. They're just not magical. They're excellent for emergency funds, short-term goals, or safely parking cash you might need soon. but don't expect them to build long-term wealth. For lasting growth, you need a strategy that combines consistent saving, investing, and smart money management. Before you open a high-yield savings account, make sure you understand what you're really earning, what you're paying in taxes or fees, and what can change over time. Rates aren't guaranteed, interest is taxable, and growth can fluctuate. Stay informed, make smart choices, and let your money work for you, not the bank. If this video helped you understand how high-yield savings accounts really work, from taxes to APY changes and smart strategies, make sure to like and subscribe so you don't miss future money tips. Thanks for watching, and I'll see you in the next video for more ways to make your money work for you.